Hello everyone, this is Juan Sarmiento and today is Friday, August the 25th. This is my second recording on this video. Unfortunately, I made some trades here and halfway through the recording I had an issue. And so I'm going to simply go through what I have done here. You can take a look. I am closing this trade. I am creating this new trade. I have adjusted this trade and I'm looking to adjust this one too. And then the others I am leaving alone. So let's start with the Apple. Analyze. Let's go create this, analyze this trade that I just got filled. All right. And I selected this trade. Very easy to do. Just look at the chart first and you can see the volatility is low. The stock reported earnings that beat expectations. The stock is moving below the Ichimoku cloud, and I think that the stock can move in either direction. So this is not necessarily the ideal. You can choose any stock that just have blowout quarters. That would be my preference, but there are not many of those. And in this case of Apple, they beat expectations, yet the stock went down and is now below the Ichimoku cloud. So the case could be made that it could continue to go down strongly and volatility might pick up, or that the stock will simply reflect more the earnings report, the value of the stock, and could rally to new highs along with the market. So, and Apple is sort of a bellwether. So let's take a look at my trade that I selected. I go to a strike price that is slightly below the current price at $75 versus the current price, which is $177. I went to October the 6th. No, that can be, yeah, October the 6th for my longs. And how much is that? Well, that's to expiration, 42 days to expiration. You can choose to do that. Ideally, you would choose 22 or 29. I realize that I made a mistake now, but it's really not a big deal, right? The long ones are the December ones with 112 days to expiration. So more than 90 days, not less. Okay, 90 days is my cutoff point. Go to the trade tab and scroll down and you would see this current IV percentile 20. Ideally it would be 15, 20 is acceptable. So I'm trying to make this trade that is really not ideal because there are not that many trades, to be honest. But I still want to play it. Look at the implied volatility, 28, 20, 25, 19. You use the calculator and let's clear the memory, and we take the average of the back month options, 28.7 here at the bottom. That's the implied volatility of the trade that I'm making. So 28.7 plus 21 divided by 2. Store that in memory. Do the same calculation for the front month, 25 plus 19.8. Divide that by 2. It gives you 22. Okay, so we subtract that from memory and then recall, and data is less than 3%. So I'm happy with that. The implied volatility is less than 3% differential between back options and front month options. So that's acceptable. Then we say create the trade, create duplicate order, and then you have mid versus natural. And you can see, well, again, calculator, 28.25. That's the natural price for this particular trade, minus 28.05, that's the mid. Difference is 0.2 divided by 28.25, and this is as narrow a margin between mid and natural as it gets. That just means it's very liquid. It will be easy to get in and get out. Okay, and so that's a positive form of trading. And we move on to Adobe. Adobe, this is our trade. Look at the risk graph. It's doing great. Okay, you can see my deltas are neutral. The stock is still trading, but the volatility has increased. Okay, look at the chart. Yeah, volatility has increased, but look, earnings are coming up. We still have 1 week to adjust this, and 1 week from now we can simply close the trade in advance of earnings, unless of course it's moved very strongly higher or lower before earnings. I don't anticipate that. You can close this trade as well if you are happy with the profits. But I usually go to 1 week before expiration or 1 week before earnings. Let's move on to Amazon. In this case, we have a bit of a loser. You see, this is my trade. How do I calculate this trade? Go to the Monitor tab, Account Statement, and go back 45 days or 90 days, whatever, some period in the past. And then you can see that you have not made any adjustment to this trade. So the original trade still stands and is a bit of a loser. And right now it's here at the bottom end of my range. So this stock might still make us money if it falls below the Ichimoku cloud. Okay, let's move on to Google. Go to the Analyze tab, show me the trade. Okay, you can see that I made some adjustments here. Go to the Monitor tab. No adjustments. It's just this is the closing order. If I were to place this close, it's right there in the middle of the cone. So that looks fine. Do I expect earnings coming up? No. So I'm going to stay on it. If the stock drops, you can expect volatility to rise, and the volatility is pretty low right now. So I'm not. What would happen if my volatility increased? My value of my trade will increase too, because Vegas are 315. That just means that for every 1 point increase on the volatility, you get $315. Then this is my original trade, and this is if I were to close it. Okay. All right, so this is what I had, and okay, I can modify, I can roll over the put side, not the call side. The call can expire. This is for next week. Yeah, so here it is. I make the change of the put. I'm closing my September 1st 120 put, and I'm selling the 29th. That's more expensive, obviously, but I'm getting some profit on it, some credit on it. And when I do that, it changes my position. The deltas become more neutral. Right now is 119. That's a little too much. So by selling, by rolling over my puts, it neutralizes my delta a little bit, and I'm taking money off the table in case the stock goes back up strongly. If it goes down, I expect volatility to increase, and then the stock will make me money. And that's the trade I did, or I'm still doing. I'm expecting to get filled. Okay, Schwab, I did. This trade has been going down. It's not positive. It's underwater, meaning $306 loss. It's not a whole lot, but I like the way it's looking right now. The stock could go further down. Yeah, or it could bounce back. So I think it's time to remove some of my puts. I already took 14, you see, took 2. We had 16 puts, now I have 14. But I sold 1 just now, 2 in fact, right here. Let's analyze that trade, and this is what it looked like. Not much change, but I'm taking some money off the table, and the delta went from negative 170 to 11. So I'm moderating my risk to the downside. If the stock continues down, volatility should increase, And this, at some point, 1 week before expiration, I'm going to close it. Okay, at a loss probably, unless something dramatic happens. UNH. This also looking good. You can see this will be this is the original trade, and I just simply can say analyze opposite, and this gives me this trade, and then unlock it. And that's, if I were to sell that position, I will sell it with a profit of $835. Am I content with that? Well, here is what it looks like. Look at the chart. Okay, this could, you figure that they will go higher to a new high because it's been moving sideways and now at the Ichimoku cloud. So yeah, this could go. I only needed to go to 500 here and then close it. Okay, I think that's pretty much it for today. Thank you very much for joining me, and see you next time. Bye-bye.